Hello, this is Dan Collins from the Dan Collins Report for Traders Exclusive. And this morning I want to talk a little bit about option strategies because I just saw an anomaly recently. I was looking in my database of managers. I've talked about how it's been a difficult environment for trend following, actually for 2.5 years, but this year as well. I thought the option managers would do a little bit better because of strength in the equity markets. But I was kind of surprised to find that of the 107 managers that are option specific, nearly, I would say 95% of them use some sort of premium collection strategy, among other things. Only 38 were positive and 69 were negative. Negative years for option traders you usually see when you have a volatility spike, when you see a bear market, a really sharp decline. And so I was kind of surprised to see this and look at a couple of things. One, of the 10 top performing options traders, 8 of them were diversified, which makes sense because you're really limiting yourself if you're trading volatility on only one asset class. So the managers that did well trade a diversified group of markets. The other point that I made a while back in one of these videos is that the option space is changing, and it's actually becoming a little bit more diversified in the fact that a lot of managers are buying options as well as selling options. This is a good thing. It helped them avoid some of the huge drawdowns with the volatility spikes. But basically, as I mentioned before, every time you open a window in options, or you close a window for risk somewhere, you open up a window for risk somewhere else, or you limit your ability to profit somewhere else. So we've been in a very low volatility environment, and this slow grind up in the equities, which in more normal environments is usually positive for option traders, has been negative. Now you add to the fact that a lot of these managers added risk management so that, to avoid, the typical bad drawdowns in a volatility spike, a huge drop in market value. Well, that was a good thing. That lowered their volatility in some areas. They lowered their exposure, but in a low volatility environment and a slow climb up, it also lowered their ability to profit. Not necessarily a terrible thing, because if these are offered as alternative investment strategies, so it's not the worst thing in the world that when you have a strong equity market where someone's portfolio is doing very well, that your strategy is not adding value. Obviously, these are absolute return strategies and you want to do well always. But the most important thing is to add returns when the rest of someone's portfolio is doing poorly. I mentioned on the Dan Collins Report this week how a story in the S&P blog was kind of interesting in how they talked about VIX as spikes in VIX hurt commodity markets. I found it odd because VIX measured implied volatility in the S&P 500, not in commodities. Generally, traders don't trade commodities because of VIX. They trade it because they fear inflation. That's why people got into the GSCI, a long-only commodity index. But the point is that now that it's very correlated with the S&P, it's not providing what it should. And that's what managed futures does. That's what managed options does. So remember with options programs, if you open up a window somewhere, you close a window somewhere else. So when you look at these strategies, it's better to be diversified. One of the managers I focused on, LJM, who did very well last year, added this risk management. They have a couple programs that are down because they put risk on this moving up. So instead of losing because of a huge drawdown, which they assured me that they could actually be positive there, well, you're limiting your possibilities to return in a slow grind up. But that's not a terrible thing, because the assumption is most people have an allocation to equities. But be aware of this when you're looking at options managers. It's a little bit different. Volatility is a strange animal, and when it's very low, managers can do poorly in these slow grinds up because of the protection they put on. This is Dan Collins for Traders Exclusive. See me on the Dan Collins Report. Thank you.